Leverage is using borrowed capital to increase your trading exposure. Leverage is the ability to use something small to control something big. In the case of Forex, it is using a smaller capital base to control a larger lot size. Basically, leverage allows you to trade with more money than you have in your account. So guys, sit while I simplify the term leverage and show you how you can use leverage the right way to avoid blowing up your trading account. All right. Welcome back to Rity Trade Hub Forex Beginners course. I am Godfrey and I am a Forex trading expert. So let's discuss another topic that makes us gain so much with such a little capital. Okay, leverage. To understand this concept of leverage, let's take a brief history of how Forex was. Initially in Forex, it's not anyone that is allowed to trade Forex. Forex are only traded by people who we call the cabals, the men of Wall Street, usually investment banks, rich men, big businessmen, company owners, and all of that. Now in Forex, then common men like you and I wouldn't have benefited from this lucrative business until the late 1990s. Only the big guys could play this game. The initial requirement was that you could trade only if you had about 10 to $50 million to start with. Okay, so Forex was originally intended to be used by bankers and large institutions, and not by us, the little guys, generally called the retail traders. So however, during the invent of the internet, the world became a global village, in that you can buy and sell from anywhere around the world. All right, this led to the proliferation of Forex brokers. Now, Forex brokers had so many customers around the world that they could solve the single problem of capital for us. So they are now able to offer trading accounts to retail traders like you and I. Then it used to be very hard for retail traders to engage in the Forex market. But thanks to the advent of the internet, electronic trading, and retail brokers, the difficult barriers to entry in Forex trading have all been taken down. Okay. So now those world banks requires a certain amount of money for someone to be able to trade with. But because brokers have pulled many amounts of money together, we are now allowed to trade through our broker. So instead of an individual trading with, let's say, $1 million, right, you can actually place a trade with as little as $10 because you did not go alone. You went to the market through your broker, who is recognized by the World Bank as a formidable force. Okay, so I believe this simple illustration is understood. All right, so guys, now your broker allows you to trade because your broker offers you what we call leverage in the Forex market. Okay, and the principle of leverage is virtually multiplying that your little capital so that you can use it and buy something worth a bigger value. For instance, when you are filling out your forms for opening of trading accounts, you will see things like leverage of 1:10, 1:50, 1:100, and 1:1000. Right, these are the leverage your broker is offering you. So what the broker is telling you, when it lets you use leverage of, let's say, 1:100 on a $100 account, is that $100 margin deposit would enable you to buy or sell $10,000 worth of currencies. Okay, now leverage of 1:100 means your $100 capital multiplied by 100, which is equals to $10,000. Now another way to look at it is that your $100 deposit is equivalent to a virtual capital of $10,000. Already we know that on a $100 account we use a nano lot of 0.001, and on a $10,000 account we use a micro lot of 0.1. Okay, so with the leverage of 1:100, it implies that you can buy or sell $10,000 worth of currencies. Let's say literally you can expose your $100 funds to a $10,000 risk. Basically it means you can use a micro lot of 0.1 on a $100 account. All right, let's take a look at another example. Okay, if a Forex broker offer you a leverage of 1:1000 on a $100 account, all right, which means that a $100 margin deposit would enable you to buy or sell $100,000 worth of currencies. All right, so this implies you give the broker $100, the broker multiplies that by 1,000, giving you $100,000 of buying power. Not $100,000 to lose, not $100,000 account. Recall, not $100,000 to lose, not $100,000 account. What this means is that you can control $100,000 worth of a specific investment or unit, but your broker will never let you lose more than the $100 you deposited or more than your $100 capital, right? Now, another way to look at it is that your $100 deposit is equivalent to a virtual, I'm stressing on that, virtual capital of $100,000. Already we know that on a $100 account, like I mentioned earlier, we use a nano lot of 0.001, and on a $100,000 account we use a standard lot of 1. Now, with the leverage of 1:1,000, it implies that you can buy or sell $100,000 worth of currencies. Okay, you can expose your $100 funds to a $100,000 risk. Basically, it means with a leverage of 1:1,000, you can open a position with a standard lot of 1, or you can open positions, you can open 0.1 up to 1 standard on a $100 account. So there's a detailed video on lot size somewhere around here or here, all right, to enable you have a better understanding of lot or lot sizes in forex trading. Ensure you watch the video if you have not done so. I'll also leave the link in the description box. All right, I always like to see that everyone is carried along. I always love to explain things in simpler terms so that you would understand it better. Okay, so how does leverage impact your trading? Here we have a column for trader A and trader B. Okay, they both made a deposit of $100, but trader A chose a leverage of 1:100, while trader B chose a leverage of 1:1,000. Yes, guys, some brokers even go as far as giving a leverage of 1:1,000. All right, so let's focus on trader A. Okay, with the buying power of $10,000. all right, trader A is allowed to buy 10,000 units of the base currency, which is equivalent to 0.1 lot size. So now we know that the original capital of $100 have been amplified to $10,000. That's leverage. So it is assumed that trader A is controlling $10,000 or base units in the market. Okay, so moving further, 10% of $10,000 is $1,000. all right, as you can see on the screen, 10% is 10% of $10,000 is 1,000. Now remember, the broker has given trader A the power or license to trade or control $10,000, all right, which is the buying power. Okay, I hope I'm making sense. If I am, let me know in the comment section, right? So let's say trader A woke up in the morning, and after his analysis, trader A decided to buy the Euro USD pair. So if the Euro USD pair goes up by 10%, remember 10% of $10,000 is $1,000. So if the market moves 10% in trader A's favor, then trader A will have $1,000 profit plus the original capital, which sums up to $1,100. I hope I'm making sense. So trader A will be up with $1,100 profit. With how much? With just $100 capital, which was amplified to a $10,000 buying power. Okay, so he controlled $100 and was able to make profit up to $1,100. This is the power of leverage are building that opportunity. Okay, so let's look at the cons of this concept. All right, so what if the market goes 10% against this trader, against trader A? Right, then trader A will be short with $1,000, right? based on leverage. So, but guess what, guys? The broker will never allow trader A to lose the entire $1,000 in question. Why? Because the capital is just $100. The capital of trader A is just $100. He doesn't even have up to $1,000 to even blow up. All right. Remember, I told us earlier that this capital is not a capital for you to live. It's just a buying power to participate in the forex market. So the capital is just $100 and leverage is $900. All right. So what happens is that before trader A loses the entire $1,000 buying power, okay, the $100 capital is already lost. All right. Trader A would have had a margin call or even run out of margin. So without leverage, this would have been a 10% loss of trader A account. Okay, 10% of $100 could be $10, right? So, but because of leverage, trader A lost 100%. Remember, the broker is seeing your $100 as a $10,000. So they are actually giving you 10% of $10,000, which is $1,000, right? But then you are placing a risk on your $100 account. Okay, so remember I told you earlier that leverage is just the amount you can control and not the amount you can lose in the market, right? So the brokers are not necessarily telling you, hey, you have a $10,000 account. They are just letting you control $10,000 worth of a specific currency. Okay, now bear in mind that whatever risk you are exposing your account to through leverage is placed on your original capital, which I mentioned earlier, and it is not placed on your buying power. Your brokers ultimately have nothing to lose. In my Nigerian language, now your account goes suffer. Okay, that simply means that your account will bear the consequences of such risk. Okay, so this same analogy is applicable to trader B. Right, let's look at leverage from the perspective of PIP. Guys, ensure you've watched my video on lot size and PIP. Okay, if you have watched the videos, you will have a better understanding of what I'm about to share now. All right, still working with the $10,000 buying power. Okay, we all know that the PIP value for a 10,000 units or 0.1 lot size is $1, right? It means if price goes up by 1 PIP, you make $1. If price goes down by 1 pip, you lose $1. Okay, if price moves 20 pips, then we have 20 pips multiplied by pip value of $1. Remember, for a 10,000 units or 0.1 lot size, 1 pip equals $1. So that's basically 20 multiplied by 1. That gives us $20. So if the trade goes up in favor of trader A by 20 pips, that's a good profit on a $100 account. Okay, so if the trade goes against trader A by 20 pips, that's a huge risk on a $100 account. Going by proper risk management, that's about 20% of your account. Well, it still boils down to your risk appetite. Okay, the same process applies to trader B. Okay, the PIP value for 10,000 units or standard lot size of 1 is $10. So 20 pips move in trader B's account to be 20 pips multiplied by $10, right, which is valued at $200. So guys, with the same $100 capital, you can see the difference. That is the power of leverage. No matter your leverage, you need to know that what is at risk is your capital. The broker will never allow you to lose more than your original capital or deposits. Okay, leverage trading is great when prices move in your favor, but then you could end up making heavy losses as well if markets move in the opposite direction. Okay, you will think the brokers are doing you a favor by offering you leverage, but they actually make more money when you expose your capital to high risk. So let's remember that leverage is a double-edged sword. Without proper risk management, high degree of leverage can lead to large losses as well as gains. So guys, it's important to use leverage wisely. Okay, let's proceed. How do you apply proper risk management using leverage? Okay, now if your broker have given you a leverage of 1:100 or 1:1000, it's not mandatory to buy 100,000 units or 10,000 units. Okay, you can choose to apply proper risk management and buy either 1,000 units or 100 units depending on your risk appetite. Basically, what I mean is, if you are using a leverage of 1:100 or 1:1000, you've got a buying power of $10,000, $100,000 respectively. From this table here, we can see that with $100,000 accounts, capital, virtual capital, leverage, or buying power, you can buy 100,000 units of the base currency, and the standard loss of 100,000 units is 1. Same applies to $10,000 accounts of buying power. You can buy 10,000 units of the base currency, and the mini lot of 10,000 units is 0.1. And with a $1,000 account, you can buy 1,000 units of the base currency, and a micro lot of 1,000 units is 0.01. Lastly, we see that with a $100 account, you can buy 100 units of the base currency, and the nano lot of 100 units is 0.001. Okay, so instead of exposing my $100 to high risk, here is what I will do. If you look at the $10,000 buying power that was given to trader A in the previous illustration, you realize that it is categorized as a mini lot on this table. Okay, now assuming I am trader A, seeing that the leverage of 1:100 is not suitable for me, considering my deposit or capital of $100, then I can decide to not use all the leverage given to me. Okay, at this point, I can choose to scale down to 1,000 units or 100 units instead of the 10,000 units buying power. Technically, I have not changed my leverage, but I have worked on my leverage. Okay, my leverage is still 1:100. I still have the buying power of $10,000, but I have decided to buy 100 units, which means I am going to trade with $100 buying power. So in this case, if the price of Euro USD goes up by 10% in my direction, I will profit $10. Okay, and if the price goes against me, then I will lose $10. So guys, that means I still have about $90 left. I have not lost all the capital. Okay, I would have lost 10 trades in a row to basically blow up my account. But then, if you can make 6 trades out of 10, you'll definitely be a profitable trader in the Forex market. Okay, as you can see, the $100 buying power gave me a small profit and as well as a small loss. But the leverage of 1:100 with a buying power of $10,000 gave a $1,000 profit and as well a $1,000 loss that actually blew up my account. So that is the power of leverage. Leverage is not actually the problem. The problem is how you use it and how you let it impact your trade. So if you go by the pip value to manage your leverage, you can also choose to scale down to the $1,000 buying power, which has a pip value of $0.1. Okay, so multiplying $0.1 by 20 pips, just like we did in the previous illustration where we have the trader A and trader B table. Okay, this 20 pips will equals to $2 as against the $20 with a $10,000 buying power. All right, the $2 may look small, but guys, consistency is key, and with this you will hardly blow up your account. I mean, it will take you 50 losing trades in a row to blow up your account. By the time you apply this principle in a big account, you will certainly understand its significance. So how do you implement this? All right, now if you are willing to risk 20 pips, all right, you may consider to open your position with 0.01 lot size. Okay, so it all depends on your risk appetite, number of pips you are willing to raise, and probably your risk to reward too. So you can still use leverage and apply proper risk management. Sometimes you see someone with a $100 account buy a pair with one standard lot because leverage avails you that opportunity. I regard that as an abuse. Okay, be careful when using leverage so as not to increase your risk. All right, both scenarios featured in this video are the same, guys. All right, with the only difference being that I presented the first example using percentage and the second using pips. So my amazing viewers, I hope I've been able to simplify the term leverage for you to better understand this concept. Thank you so much for watching. I appreciate your support, and once again, thank you for making it to the end of this video. If you got value, go ahead and hit the like button, and if you'd like to get notified when I post a new video, go ahead and subscribe and turn on post notification to be notified when I post a new video. And lastly, guys, if you're lost in any of this concept and you would want me to take you one-on-one to guide you to better understand these terms, kindly sign up for my mentorship using the link in the description box below, and I will see you in my next video.